Hold on for a moment there and stop scrolling. If you're between the ages of 45 and 65, this isn't about speculation. It's about protecting your legacy and your bag. These next 90 seconds could matter more than ever. What you're about to hear could decide whether your XRP holdings remain sidelined or become part of the next dominant wave. For context, XRP is trading around $2.98 right now at the time of this video production. If you're watching this later, that may have shifted. Make sure that you like and subscribe this video. It really helps me get the message to the masses and is greatly appreciated. Quick disclaimer for you, I am not a financial advisor, and this information is for educational and entertainment purposes only. Always do your own research and consult your own professional financial advisor before making any decisions that could put your finances at risk. Let's open with a question that cuts to the core. What happens when the rails of global finance quietly shift underneath your feet and you only get one shot at positioning before the move? Because that's exactly where we stand, and it hinges on a new development many aren't talking about yet. In a moment, I'll break down how Swift's announcement, Ripple's leadership shifts, and XRP's liquidity squeeze could converge into a revaluation event you won't see coming, especially if you're watching from the sidelines. But first, you need context. The old payment rails are under pressure. Cross-border transfers still take days. Liquidity corridors remain fragmented. Technologies like Swift, which have long served as the backbone of international messaging, are now flirting with distributed ledger systems, tokenized assets, and smart contract rails. That's not a rumor. That's the direction the industry is being pushed. Ripple, XRP, and its connected infrastructure have long claimed their place in that shift. But until recently, much of that talk has lived in proposals and pilots. What's changing now is the plumbing. Alliances, integrations, and institutional capital that demand stability, governance, and alignment. And with David Joel Katz Schwartz shifting from CTO to board, Ripple has just made a structural move to match that ambition. So why does that matter to you? A holder, a believer, someone watching the charts? Because in this next transition, price will stop being about hype. Price will become infrastructure, the cost to secure liquidity, to access corridors, to stand as a trusted bridge in the global flow of capital. I want you to imagine a future where the world's biggest banks don't look at XRP as another spec play. They see it as a utility reserve, where funds, custodians, and institutions hold billions of XRP not because of momentum, but because it is woven into the web of real-time settlement. That future demands maturity. That future demands structure. Ripple just moved a key piece of that puzzle. Now here's where the tension builds. Supply is already constrained, exchange balances are draining, and institutions are circling. In that environment, the difference between a strategic entry and a missed opportunity becomes razor thin. You'll want to be positioned before the move, not chasing it after. Stay with me. In the next section, I'm going to unpack the mechanics of the upcoming liquidity shock, how institutional absorption will trigger revaluation, and why many XRP holders will be left behind. Do you want me to continue? Here's the part most people miss, and if you're watching closely, you're going to understand the game in a way that 95% of retail never will. The financial system doesn't break all at once. It breaks in stages, and the unwind is already happening. Think about the 10 trillion plus carry trade unwinding in Japan. That's not just a number on a Bloomberg screen. That's leverage being pulled back out of the system, liquidity evaporating, and capital flows that once seemed permanent now being yanked in the opposite direction. When that happens, everything tied to dollar strength, yen weakness, and bond fragility suddenly gets exposed. And if you think the bond market doesn't touch you as an XRP holder, think again. Bonds are the foundation and the price of money itself. If that foundation wobbles, everything sitting on top of it shakes. Now picture this. As bonds destabilize, equities wobble, and FX markets get volatile, institutions are forced to find buffers. They need settlement assets that are fast, liquid, and globally neutral. They need bridges that don't seize up when the old rails choke. Enter XRP. This isn't speculation. This is the exact scenario Ripple and its partners have been preparing for over a decade. Remember SBI Holdings in Japan? They've been quietly building corridors with Ripple for years. Remember the Bank of Japan's digital yen trials? Look closer. Interoperability is always the key word. And who has been pushing interoperability as the crown jewel of financial plumbing? Ripple and the XRP ledger. So here's how it plays out, step by step. First, liquidity stress cracks the old rails. A mismatch between demand for settlement and the ability of the system to deliver it. Second, alternative rails that are already tested and scaled begin to pick up the slack. Third, the institutions that saw this coming look like visionaries, while the ones caught flat-footed scramble to get exposure to the assets running those rails. That's where XRP fits in. It's not trying to replace SWIFT. It's not trying to replace central banks. It's positioning itself as the bridge, the layer that connects digital yen to digital euro, tokenized bonds to stablecoins, emerging market remittances to US dollar liquidity. When stress hits, bridges become priceless. And this is where retail psychology gets tested. Most retail traders are looking at short-term charts. They see a dip and panic. They see volatility and assume weakness. But institutions, the players who move billions, they look at structural positioning. They know that in times of stress, settlement assets with speed, finality, and neutrality gain premium status. And they know supply is thin. Now don't miss this next 60 seconds, because this is the single most important trigger behind the revaluation setup. XRP doesn't need to become the reserve currency of the world to see massive repricing. All it needs is for demand to spike in one or two critical corridors while supply is locked in custody. That's the shallow lake effect, a big wave of demand hitting a lake that looks wide but is only inches deep. Prices don't just move, they jump. And here's the twist. While all of this unfolds, Ripple just shifted Schwartz from CTO to board member. That might sound like an inside baseball detail, but think strategically. As CTO, Schwartz drove technology. As a board member, he influences governance, direction, and the very deals that decide where Ripple plugs into the system next. That's not a downgrade. That's a power move. And it signals Ripple knows the next phase isn't about code. It's about policy, positioning, and integration at the highest levels. So ask yourself, when the bond market wobbles, when carry trades unwind, when liquidity vanishes, do you want to be holding the asset that institutions view as a buffer? Or do you want to be chasing charts while the insiders quietly build positions? Because make no mistake, this is the divergence moment. Stay locked in. In the next section, we'll drill into exchange supply, ETFs, and why custody wallets are shrinking the available float faster than anyone realizes. This is where the shallow lake turns into a drought, and it's the part nobody else is explaining. Do you want me to keep going? If you've made it this far, then congratulations. Most people click off halfway through, distracted, skeptical, or just not ready to hear the truth. But you've stayed locked in. And because of that, I'm going to reward your patience. Over the next 60 seconds, I'm going to reveal why XRP's position in global finance is fundamentally different from anything you've ever seen before, and why this is not speculation, but structural. Trust me, you're going to want to stick around. Because if you miss this, you may miss the critical piece that separates winners from the washed out. Let's start by comparing XRP with the two assets it's always lumped in with, Bitcoin and Ethereum. Bitcoin is the original scarcity play. 21 million coins hard cap, no more will ever exist. That scarcity makes it digital gold, and in an age of money printing, it shines as an insurance policy against debasement. Ethereum, by contrast, is programmable money. It's not just currency, it's infrastructure. Billions of dollars in decentralized applications, smart contracts, and protocols run on it. Ethereum is the digital economy itself, constantly evolving with scaling solutions and fee structures that mimic revenue-generating networks. Now here's where the picture gets interesting. XRP is neither Bitcoin nor Ethereum. It's not primarily a store of value, nor is it the backbone of DeFi speculation. XRP is something far more specific. It is settlement-grade liquidity designed for institutions, banks, and cross-border flows. While Bitcoin and Ethereum are powerful, their use cases are broad and diffuse. XRP's use case is laser-focused, instant settlement, interoperability, and liquidity provisioning for the largest money markets on Earth. That's why this isn't just a speculative narrative. This is about infrastructure. If you strip away all the noise and look at what institutions actually need, it comes down to three things: speed, cost, and interoperability. Traditional SWIFT rails take days, are costly, and siloed. XRP cuts those to seconds, fractions of a penny, and bridges multiple currencies simultaneously. That's not hype, that's engineering. Now pause for a moment and imagine this scenario. An ETF is approved. Institutional custody absorbs billions in XRP. At the same time, Ripple's on-demand liquidity corridors expand globally. Suddenly, XRP isn't just traded, it's used. Each corridor creates daily transactional demand. Each ETF locks away more supply. Each custody wallet removes tokens from retail markets. And as this convergence accelerates, price doesn't climb steadily. It leaps, gaps, reprices in ways that shock those who didn't understand how shallow the liquidity pool really was. And here's where psychology enters again. Retail is conditioned to chase. They look for confirmation, for news headlines, for proof. Institutions act before the headlines. By the time retail sees the news, institutions already own the float. That's why so many people get shaken out at the worst possible moment. The irony is painful. The more uncomfortable it feels to hold, the more critical it is to stay positioned. So why does this matter now? Because we're entering the most pivotal point in modern financial history. The bond market is fragile, the carry trade unwind is real, and global liquidity is shifting. Every time in history when liquidity expanded after a contraction, scarce assets revalued. It's not theory, it's math. Rates cut, liquidity injects, capital seeks return. Stocks rally, commodities rise, and this time digital assets, with true institutional-grade use cases, are going to be at the center. Here's what most people don't grasp. XRP is not competing with Bitcoin and Ethereum. It's running in a parallel lane. Bitcoin will always be digital gold, a store of value. Ethereum will always be programmable money, a digital economy. XRP is settlement plumbing. And just like plumbing, you don't notice it until it breaks. But when it works, it carries the weight of trillions. Now I want you to lean in, because this is the part that flips the script. If you've held through the noise, if you've endured the FUD, if you've seen the lawsuits, the delays, the disbelief, then you're positioned for something that only happens once in a generation. The revaluation of infrastructure assets. And make no mistake, XRP is about to transition from speculation to infrastructure. That's when the calm you see today will transform into something irreversible. Let me give you the phases one more time so they lock into your mind. Phase 1, liquidity crunch. That's where gaps appear, where headlines scream, where disbelief dominates. Phase 2, utility scaling. Corridors light up, daily demand accelerates. Transactional flows anchor the bid. Phase 3, institutional dominance. Custodians and ETFs hold the majority float. Retail scrambles for leftovers, and those who held early sit on life-changing positions. If you take nothing else from this video, remember this. The market never politely waits for retail. It never telegraphs the move in a way that makes you comfortable. Revaluations don't happen on your timeline. They happen suddenly, violently, and then they never look back. And so here's the ultimate reveal, the one thing that could matter most for your future. The calm you see right now in XRP markets is not safety. It is silence before the storm. The floodgates are not creaking open slowly. They are about to burst. And when they do, the repricing will not be incremental. It will be transformational. So ask yourself, are you waiting for confirmation like everyone else? Or are you already positioned for what comes next? Because history shows the choice you make now is the difference between regret and generational wealth. Stay sharp, stay prepared, and don't underestimate the silence. Because when it breaks, it won't be a ripple. It will be a flood. Now that we've set the stage, let's dive into the mechanics of what happens when the system actually starts to shift. Because make no mistake, we're not talking about a smooth, polite adjustment where markets calmly agree on new pricing. We're talking about a chain reaction, a liquidity unwind that can either happen in controlled order or erupt in outright chaos. And right now, the balance between those two outcomes is razor thin. Start with the $10 trillion plus carry trade tied to Japan. For years, investors have borrowed cheap yen and plowed that capital into higher yielding markets. It worked when rates were flat, but with volatility in currencies and bonds, the foundation of that trade is under stress. If that trade begins to unwind quickly, it forces massive liquidations across bonds, equities, and FX. That's not speculation, it's math. When one domino falls, liquidity evaporates, and players scramble to unwind leveraged positions. Now here's why that matters for XRP. In a liquidity crunch, markets desperately need assets that can bridge value quickly and efficiently. The traditional system is slow, fragmented, and unprepared for 24/7 shocks. XRP was built for that exact scenario, to move value seamlessly across borders instantly without being shackled to old rails. That doesn't mean XRP avoids volatility. It means in the chaos, it becomes a lifeline. Think about the global bond market. Trillions tied up in long-dated treasuries that are now underwater as rates climbed. Think about FX desks that suddenly can't settle efficiently because counterparties are stressed. Think about equities being dumped for liquidity. In that mess, institutions don't look for hype coins or speculative gambles. They look for rails that work. And this is where XRP's infrastructure comes into play. On-demand liquidity corridors, interledger protocol, ISO 2022 compliant messaging. It's boring tech until it's the only tech that can handle the stress. And here's where the suspense sharpens. Because while most retail investors are busy refreshing price charts or fighting online over predictions, institutions are gaming out the scenario in advance. They know that when liquidity squeezes, you don't have time to build new systems. You use the rails already tested, already integrated, already compliant. That's why Ripple has spent years building corridors quietly, while the spotlight was on lawsuits and headlines. Now don't miss this next 60 seconds, because this is the single most important trigger behind the revaluation dynamic no one else is explaining. If you tune out now, you're going to miss the moment where infrastructure collides with demand. Here's how it works, step by step. First, liquidity stress builds in traditional markets. Bonds sell off, equities wobble, FX spreads widen. Second, institutions scramble for settlement options that aren't clogged or fragile. Third, the pipes that Ripple has been laying for years suddenly light up. Banks flip the switch, not because they want to speculate, but because they need to move money. Fourth, that usage creates daily structural demand for XRP liquidity. Not hype-driven buying, but mechanical, persistent flows. And when that demand hits, supply will not be ready. Remember, exchange balances are at multi-year lows. Custodians are absorbing coins. ETFs will lock up even more. The float is a puddle disguised as a lake. So when institutions pull on that liquidity, prices don't drift higher, they gap. That's the part retail doesn't understand until it's too late. Now let's talk order versus chaos. In an orderly unwind, regulators coordinate, central banks inject liquidity, and institutions quietly transition to new rails. Prices still gap, but the narrative is markets adapting. In a chaotic unwind, stress breaks something. A bank, a bond market, a currency peg. When that happens, the move is violent, sudden, and unstoppable. Either way, XRP is positioned as the buffer, the bridge in a world where everything else looks brittle. But let's be clear, this isn't just about XRP mooning overnight. It's about utility locking in. It's about Ripple, SBI, BOJ, and other players proving that digital rails can hold during stress. And once they prove it, there's no going back to the old system. The genie doesn't go back in the bottle. That's when adoption accelerates. Now think about this. Institutions don't move billions without a governance signal. That's why Schwartz's shift matters. That's why Ripple aligning with ISO 2022 matters. That's why Swift building distributed ledgers matters. These aren't accidents. They're all puzzle pieces clicking into place at the same time. The bottom line is simple. The unwind is coming. Whether it's gradual or violent, the result is the same. Liquidity is forced into new rails. And XRP is standing there with open corridors. You don't want to be trying to enter after the gap. You want to be positioned before. Stay with me, because in the next section, I'm going to peel back the curtain on what really happens when exchange supply vanishes, ETFs absorb flow, and custody wallets lock tokens away for years. This is where the shallow lake analogy becomes reality, and where most holders will realize too late that the market they thought was deep was only inches thick. Liquidity is one of those words that gets thrown around casually, but in markets, it's everything. Liquidity is the difference between orderly price discovery and violent revaluations. And right now, when it comes to XRP, liquidity is vanishing faster than most people realize. Let's start with the exchanges. A few years ago, it looked like XRP supply was endless. Billions of tokens sat openly on exchange order books. But fast forward to today, balances are at multi-year lows. We're not talking about tiny percentages. We're talking about a cliff dive. Why? Because custody solutions are pulling XRP off exchanges. Institutions, funds, and long-term holders don't leave tokens exposed on open markets. They move them to cold storage, custody vaults, and ETFs. And once they're there, that supply is gone for years, maybe decades. Imagine a shallow lake in summer. From above, it looks like there's water everywhere. Step in, and you realize it's only ankle deep. That's the XRP market right now. On the surface, billions exist. In practice, the float available for real trading is tiny. And when demand slams into that shallow lake, the water level doesn't rise gradually. It splashes violently. That splash is price revaluation. Now add ETFs into the equation. The streamlined approval process for altcoin ETFs, including XRP, is no longer a hypothetical. The framework is already there. That means a single BlackRock tier issuer could launch a product and soak up millions of tokens in days. Those tokens won't be sold back into the market each week. They'll sit locked inside the ETF wrapper, owned indirectly by pension funds, institutions, and retail investors who never touch the underlying asset. Every XRP locked away this way shrinks the already shallow float further. Custody makes the problem, or opportunity, even more extreme. Big players aren't just buying XRP casually. They're structuring it inside multi-year custody contracts. That's collateral, reserves, or infrastructure capital. And once tokens move there, they're not coming back to retail exchanges. Think of it like bricks in the foundation of a new financial system. Once laid, they don't move. And this is where psychology takes over. Retail investors see flat charts and convince themselves there's no urgency. I'll buy later. It's not moving, so I'll wait for a dip. But institutions think differently. They accumulate when the water is calm, precisely because they know what happens when demand hits a shallow pool. The patient accumulate before, the impatient chase after. Now don't click away, because in the next 60 seconds, I'm going to show you the exact revaluation phases that could blindside the majority of XRP holders. Here's how it plays out. Phase 1, the liquidity crunch. This is where exchange balances drain, custody grows, and ETFs start absorbing supply. Prices may move modestly, but the structure changes under the surface. Phase 2, utility scaling. Corridors light up, Ripple's rails are used in stress environments, and institutional flows require XRP at scale. Prices gap, not because of hype, but because demand collides with scarcity. Phase 3, institutional dominance. Once ETFs, custody, and banks hold the majority of tokens, retail becomes a marginal player. Prices stabilize at higher floors, volatility compresses, and XRP transitions from speculation to infrastructure-grade capital. Each of these phases leaves fewer opportunities for the average investor to accumulate meaningfully. By the time most realize what's happening, the door is already closed. That's how wealth transfer occurs, not in one massive move, but in waves that gradually lock retail out. We've seen this playbook before. Bitcoin was once easy to mine on a laptop, then it was easy to buy under $1,000. Then under $10,000. Now ETFs and institutions hold billions, and the idea of stacking meaningful amounts feels impossible to the average investor. Ethereum followed a similar pattern, with early adopters accumulating cheap tokens before DeFi and NFTs absorbed supply. Now ETH sits inside custody solutions, corporate treasuries, and ETFs. The shallow lake dynamic has played out every cycle, and XRP is next in line. The difference with XRP is its unique utility alignment. While Bitcoin is digital gold and Ethereum is a digital economy, XRP is literally the bridge, the settlement layer that can tie together fiat, tokenized treasuries, and CBDCs. That role isn't speculative, it's structural. And structural demand doesn't care about retail's timing, it builds floors whether retail participates or not. Think about the psychological shift. Retail sells dips out of fear. Institutions buy dips because they know liquidity cycles drive assets higher over time. Retail chases green candles. Institutions quietly absorb when no one is paying attention. That divergence is why charts look the way they do. Flat, boring, then explosive. The boring period is the accumulation zone. The explosive period is the revaluation event. Most retail miss the boring and chase the explosive. Now picture the day ETFs launch and custody flows peak. Suddenly millions of XRP are absorbed in a week. Prices gap from $3 to $5. Retail panics in, this is the breakout. But by then, liquidity is already thin. Another ETF launch pushes the float lower. Prices gap again, $5 to $8. Retail scrambles again. The process repeats until the floors are well into double digits and retail can't stack meaningful positions anymore. That's the script. That's the transfer of wealth from the impatient to the patient. And here's the part most won't believe until it's too late. Once institutions build floors, they don't sell back down. That's not their playbook. Their capital isn't trading on Telegram signals or meme hype. It's structured, strategic, and multi-year. That means dips get shallower, recoveries get faster, and the long-term trajectory locks upward. Volatility compresses, floors rise, and retail investors who waited for the perfect entry are left with scraps. Stay with me, because in the next section, I'm going to reveal why XRP's setup against Bitcoin and Ethereum could be the biggest blindside of this entire cycle. If you made it this far, don't click away now. The ultimate reveal is about to hit. And it's the detail that could separate winners from regret for the next decade. Bitcoin, Ethereum, and XRP often get lumped together, but they represent completely different categories of value. Bitcoin is digital gold, Ethereum is programmable economies, and XRP is liquidity infrastructure. That distinction matters more than ever as institutions prepare to allocate trillions. Bitcoin will always have brand power as a hedge against debasement, but its capped supply and slow settlement mean it's a reserve, not a payment tool. Ethereum thrives on network effects. Billions locked in DeFi, NFTs, and applications. It's the operating system of digital finance. But XRP, it was engineered from the start to move value, not store it. It's the bridge. Its breakthrough won't come from hype cycles, but from integration into global financial rails. And here's the kicker. When that happens, revaluation won't look like a retail bubble. It will look like sudden price discovery because banks, custodians, and funds need it. Even 1% of daily cross-border settlement demand could dwarf all speculation combined. That's the math most ignore. Most XRP holders will still sell too early, $5, $10, $20, handing supply back to institutions who will hold for decades. The patient become the new 1%. The impatient watch history pass them by. Now don't miss this. If you've stayed with me this far, give me 60 more seconds. Retail narratives are fading. The only thing that matters is whether you own enough XRP when liquidity gates open. ETFs will lock tokens away, custodians will absorb supply, utility demand will scale, and repricing will happen in leaps, not gentle climbs. Picture the calm right now as silence before the storm. Most think they have time, but when demand collides with scarcity, the storm doesn't creep in. It hits in a flash. XRP is the blind side, the piece retail underestimates, the one institutions align around. When the dust settles, you'll either be positioned or chasing what slipped away, like comment and subscribe for more.